Welcome to the first trading sessions of 2026. Usually, the new year brings a wait-and-see approach, but today, Wall Street is electric. Despite a 2025 defined by aggressive reciprocal tariffs and trade friction, the S&P 500 closed the year up 16%. Why the euphoria? Investors have moved past the initial tariff shock and are now pricing in a market-friendly policy mix. The fear of a trade-induced recession has been replaced by the hope of deregulation and corporate tax cuts. But as we open the books for 2026, we must ask, is this genuine confidence, or are we just riding the momentum of a debt-fueled rally? The Federal Reserve is shifting gears. Markets expect a rate cut to the 3.25% to 3.50% range early this year. The paradox? Core inflation is still hovering above the 2% target. The Fed is pivoting from inflation fighter to job protector. With the labor market cooling and a 2.8% cost of living adjustment taking effect this month, the Fed is choosing to support growth over a strict 2% mandate. They'd rather risk a low-grade fever of inflation than a full-blown economic freeze. On New Year's Eve, President Trump signed a surprise proclamation, a one-year pause on tariff hikes for upholstered furniture and kitchen cabinets. These were slated to jump as high as 50% today. This isn't just a sign of softening, it's a tactical retreat. By delaying these specific costs, the administration is attempting to lower the barrier for home renovations and stabilize the housing market ahead of the 2026 midterms, while keeping the tariffs as a leverage tool for ongoing trade negotiations. The AI hype has matured into the AI reality. This year, it's not about who has the best chatbot, it's about who has the best margins. Take Tesla, for example. Even as EV deliveries saw a 15% dip in Q4 2025, its stock remains resilient. Why? Because Tesla is being valued as an AI and robotics powerhouse. With the Cybercab hitting mass production soon and FSD, full self-driving, adoption growing, the market is betting that software and autonomy will eventually replace the revenue lost from traditional hardware. But every bull market has its shadows. Gold hitting nearly $4,370 per ounce is a screaming siren. Gold doesn't pay dividends, it only climbs when people are terrified. This record reflects a world on edge, from the unresolved friction in Ukraine to new U.S. naval pressure on Venezuela. Furthermore, the national debt is approaching $39 trillion. While GDP is growing, the cost of servicing this debt has become the second largest federal expense. For the average American, a growing economy feels hollow when the cost of living, driven by a 310% surge in customs duty collections, continues to strain household budgets. So, how should you navigate 2026? The tech giants are starting to look crowded and expensive. We are seeing a strategic rotation into small-cap value stocks. These domestic companies stand to benefit most from lower interest rates and the Made in America policy shift. They are less exposed to global trade retaliation than the Magnificent Seven. 2026 is a year of transition. Stay optimistic about innovation, but keep a healthy stack of safe haven assets like gold. The party is still going, but keep one eye on the exit door. What's your move? Let us know in the comments.